Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Joe Fairless. He co-founded Ashcroft Capital, which has over $2.8 billion in assets under management, while also creating the best real estate investing advice ever show podcast, the longest running daily podcast in the world, with over 500,000 monthly downloads. So thank you so much for coming on the show today, Joe.
Charles, looking forward to it and grateful to be here.
You have a fantastic background before getting involved with real estate. Can you tell us a little bit about yourself, both personally and professionally, your background prior to getting involved with what you're doing now and investing in real estate?
Yeah, sure. So I went from Texas to New York City out of college, a major culture change, and I was making $30,000 as a junior project manager at an advertising agency on Madison Avenue. I had $15K in student debt. So needless to say, I didn't have any discretionary income to invest or do anything outside of just pay the bills, and barely at that. And then I kept my living expenses low for New York City. And, I eventually lived in a 2-bedroom apartment with a roommate, always had a roommate in that apartment. And, it was a 2-bedroom with no living room, with a dorm style fridge, no central AC. The one of the bedrooms didn't have windows. So I would take a washcloth and I'd put it in the fridge, and then it would get really cold. And then I'd put it on my forehead right before I went to bed. And,
Jeez.
and then in the middle of the night, I'd wake up, I'd be sweating, then I'd swap out washcloths. So that's what I did for 9 years in that apartment. And my friends would make fun of me because they said I was living like a college kid, and they were right. But the reality was, I was also saving my money as I climbed the corporate ladder. I ended up making about $150,000 as a youngest vice president at an agency on Wall Street. And I bought my first house in 2009, October of 2009, in Duncanville, Texas, which is south of Dallas. And then I bought another house the next year, and another next year, and another next year. I ended up with 4 homes, and I realized that they were good investment deals, but I wasn't making the cash flow that I wanted. I was making $250 a month on paper in my spreadsheet, but I wasn't making it in my bank account because someone would move out, and it cost me about $3,000-$4,000 to get it move-in ready. And I was in the middle of that, buying the homes and realizing that. And my friends were asking me, well, how are you doing this? What's going on? I was working like 9 a.m. to 9 p.m. pretty much Monday through Friday every day. And they're like, how are you doing this? And so I started teaching a class on it on the weekends, how to invest where the numbers make sense, even though you're living in New York City. And then one of my former bosses at the time said, if you ever do something larger, let me know. And I knew at that point I had a customer before I had a product. I had an investor before I had a deal. And I started looking at larger deals.
So that was the turning point going to single family to multifamily. Can you tell us why you chose real estate? Obviously, you weren't involved with real estate in New York. I don't know what you're working on for marketing campaigns, but what was the reason for actually choosing real estate as a whole as an asset class?
I wanted something that I could control the outcome of. When I had my first $1,000 that I had saved up, I was walking to work, and I passed a poster at a Bank of America, and it said, CD, I forget the percentage, like 1.2%, whatever it was. And I was like, well, that's more than I'm making now in my bank account. Let me do that. It was a 12-month CD. It's my only $1,000 extra that I had. They held my $1,000 hostage for 12 long months. And then at the end of it, I get $20. And then I get taxed on the $20 at tax season. I'm like, okay, there's got to be a better way. And I read a lot of books. One of them was Investing for Dummies. And in that book, they write about that you have 3 different types of investments: stocks, bonds, investing in LLCs or startups, and real estate. And I just naturally gravitated towards real estate because, I lived in apartments. I lived in an apartment growing up after my parents divorced. We lived in one for a year or two, and I was just I lived in an apartment in New York City for 10 years. I was just more familiar, more comfortable with real estate and apartments versus, investing in startups, because I knew I could influence both of those. I couldn't influence the stock market. So I decided, I'm going to focus on real estate. It's just a comfort level.
Yeah, that makes perfect sense. It's obviously something that everybody has contact with, no matter if you own it or you rent it or you're in it. It's
Yeah,
yeah, and also everybody knows someone. I found this out too. Everybody knows someone that's made money in real estate one way or another.
true.
Every time you say
Yeah,
something, they're like, "Oh, my brother-in-law," or something this, that, or, you know what I mean? Whatever it is.
that's a good point.
Um,
That's interesting.
so it's like more familiar, like you said, with it than hey, like put this money here, and 10 years we're gonna, like, whatever, something crazy, 100x it or something. People don't understand that. So, but what was that kind of your journey? You had the 4 single family houses, you're a long-term landlord, on paper, or yes, on paper in your spreadsheet, and your spreadsheet money, you're making $1,000 a month. What was that process of going, after talking to your boss, which obviously is like really kind of put everything together? What happened to get you to buying larger apartment complexes? Because it's one thing getting you have an income, you can get a mortgage on a one family or a single family house, no problem. I mean, it's a whole different ball game going into commercial and then going to large commercial like you did.
There was no segue. I went from 4 single-family homes to a 168 unit apartment community, and it was challenging. And I made every mistake in the book that I could make on that deal, and learned a lot of lessons. Um, so it was a master lease with option to purchase. So I didn't need to be approved. You mentioned the loan. I didn't need to be approved for a loan because the seller was leasing it to me and my investors, and then we had an option to purchase it at a later date ideally at that value that we agreed on. But ideally, we would increase the value, make it more valuable, and now we're buying it at the fixed value that we agreed on a couple years ago, but now it's more valuable. It didn't work out that way. And the reason why is because of my lack of due diligence on the property, my inexperience in asset management, property management, you name it. And
Sorry, that's a Texas property. Were you in New York at the time?
that's a Cincinnati property, actually. Yeah, so I was in New York at the time.
Okay.
So the 4 single-family homes I purchased were in Texas, DFW. And then I'm living in New York City in this part of my life, and I had found a deal in Cincinnati, Ohio, and never had visited Cincinnati, Ohio. Was born in Flint, Michigan, but that's as close as I got to Cincinnati. And then moved to Texas when I was 3. So it was Cincinnati, Ohio, 168 unit, a master lease with option to purchase. Made all the mistakes I could make. I actually moved to Cincinnati from New York and moved into the model unit to try and turn it around. I would pack up my stuff every morning, walk to the leasing office, and then show that model unit to try and lease apartments. I would go to Home Depot and put my pack my Corolla's trunk with asphalt filler, and then shovel it into the potholes in the parking lot at night. And I was doing everything I could, but it wasn't enough because I didn't set up the deal for success at the onset. So I ended up losing money on that deal, but I paid back my investors plus a 14% return out of my own pocket. And it was, I got, one investor who's invested with us 20 plus times on that deal. And a couple others were very, well, they're all appreciative. One sent me a 2-page handwritten letter. Another one sent Ruth Chris gift cards. So, one thing I learned is that I'm good at certain things, and I'm not good at other things. And when I went into, I went from the jump from 4 single-family homes to 168 unit apartment community. When I made that jump, um, I was taking on everything, and I was competing against people who have been in the industry decades with a lot of experience. And so what I realized is that I need to focus on my strengths and then find a business partner who has strengths that I'm not in areas I'm not strong at. And so that's when I met my business partner. And then we then found our first property and purchased it in Houston. And we bought it for I think 14.1 million and appraised for 21.6 about 2 years later, and did a cash out refinance for investors, and it was great. And so I was like, okay, well, this is a business model that I enjoy a lot more. And I knew that the business model was solid, but my execution of it was not. And so I just optimized the people in the business model, namely myself, and moved myself towards one area versus the whole thing. And things worked out.
Yeah, putting the right people in the right seats, right? That's what they say.
That's right. Yep.
So your firm has nearly $3 billion in assets under management. Can you kind of break down your company's investment strategy and criteria currently, what you guys are working on, what kind of properties you look for?
Yeah, it's evolved. It's always been and always will be value add deals. At the beginning, it was value add deals that were older and in rougher areas. We learned our lesson. Our second deal was in an area called Greens Point in Houston, but locals call it Guns Point, to give you an idea. So that was our second deal. Then we've evolved from that to not newer, nicer Class B properties. And then most recently, in our business model is you go and you renovate, you increase the quality of living for the resident, increases the value of the property, and then sell. Most recently, and we have a deal right now where we are buying a 2021 property, but it's a value add deal. It's a value add deal, 2021 property, because of the mark to market opportunity. And for those who might not be familiar with mark to market, it's simply taking the rents to where they're at currently to the market level. You mark the rents to the market level. The reason why they're not at the market level currently is because the property has been competing with 3 properties around the corner that are new construction, and they were doing the lease up phase. And during a lease up phase, the owner or the developer wants to get out of their new construction loan. They want to get in permanent financing, or they just want to get out of the deal in general and move on to go develop and create something else. And so they're going to be really aggressive with their lease ups. And as a result, the surrounding properties are going to feel that aggressiveness and have to compete and lower their prices and have concessions. And so that's what they were competing against. And now those 3 properties across right down the street, they're at 80% occupancy on average. So the end is near for that period of time for those 3 properties. And now we're coming in about a month or so, going to buy the property. And now we're going to be able to benefit from the rents currently being lower and have a mark to market opportunity. So it's a rare find where you've got a value add deal that's a Class A property, and phenomenal school district. The tenants make $115,000 at this property. I mean, it's pretty incredible. 5 minutes from Disney. So that's the type of stuff that I'm seeing not very often, but those are the type of deals between now and the next 6 to 12 months. We have a window of time to buy these types of properties. And then after 12 months, and I can talk about it if you'd like, but after 12 months, I think the opportunity in the window will close.
Why is that? Why would you say that?
Because right now we're experiencing a historical amount of supply for multifamily, and that spigot's about to be turned off in about 12 months. And so you've got right now in the headlines tons of supply hitting the market for multifamily, and they're absolutely right. What's interesting is that occupancy nationally is 94.2% in multifamily, and held at that level the last 3 months. So even though you've got a bunch of supply hitting the market, and just to give you an idea of the supply, the average completions per calendar year for the last 23 years has been 217,000 completions. This year, just for the first half of this year, 284,000. It's incredible. But the average occupancy is held strong at 94.2%. So you've got occupancy that's hold and serve with a historic amount of new supply that was developed from the lower interest rate days. Well, raise your hand if you think construction projects pencil right now, right? Like they don't pencil for a lot of reasons. And so the new construction that's taking place, the new construction starts, the new permits, I mean, they're non-existent right now. And we're going to see that transpire starting in about 12 months. And so the whole narrative, all the headlines about multifamily in about 12 months about the shift from tons of supply to tons of demand and no supply. And that's why I think within these next 12 months, while there's still a bunch of supply coming, you've got some opportunities to capitalize on that, because in about 12 months, there's going to be way more demand than supply. And if you're a multifamily owner, you're going to be in a good spot.
Yeah, there was I had brokers tell me a couple of years back, or they would tell me, survive till 25, and that was kind of the thing, because you have that 3-year window, as you're kind of alluding to, where it starts till they actually get delivered, right? Till they're actually pulling, the COs. So the thing that was that during that time, and as new inventory is coming on now, and those concessions burn off little by little, you know what I mean? When they're selling those properties, stuff like that, and it's going to get back to more of where the rents are, which is probably a few $100s more per unit than what you're going to be, a B class property. So you're going to have your tenants come back to your B class properties, because it's going to be a lot more expensive in those A class properties, those new deliveries.
Yeah, that's right.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So as you've grown your business, I mean, what are some of the factors? I mean, you guys were getting your kind of getting your footing, and you guys have really grown this, and you and your partner. What are some of the kind of the main factors behind how you've had such explosive growth over the past? I guess it's been 6-8 years.
10 years. Yeah. August of 2015 is when we bought our first property. So almost 10 years. Uh, we complement each other well as partners. We respect each other, and we both have okay, this happened, what's the solution mentality. We don't dwell on challenges for the sake of complaining about them. You know, whatever it happened, what's the solution? What's the challenge? How do we focus on this? How do we focus on the solution? And let's talk about that. Both of us are like that, and it's a trickle down effect, because he oversees operations and acquisitions, and I oversee you know investor relations, investor services, and marketing. So we oversee, between us, all the departments. And I think having that solution oriented mindset is the big thing. Obviously there's tactical things along the way, like taking property management in-house. We only manage our own properties. We have construction management team in-house. We buy our materials direct from overseas, and we ship them to our warehouse in DFW. And then we have a kitting process at the warehouse where we kit those renovation materials and ship them on a pallet to the specific properties. So we have like a little, mini Amazon that saves us about 30% relative to retail pricing, because we're buying direct from the vendor, or the supplier. And oh, by the way, we get custom materials through that process that nobody else has. So even though we're saving money, we're also getting custom materials because we're working directly with the manufacturer, I should say. And so that shows, I mean, when someone is looking at 2 or 3 different apartments as a prospective resident, you see a different light fixture that stands out, that perhaps, someone else, the 2 other apartments, they've got the same light fixture. It's a small thing, but those small things lead to big results on the bottom line. So I think that was, those are some things that come to mind that has helped us get to where we're at.
Any tips for people looking to partner? I mean, you guys have 10 years as a partnership, being very successful.
Yeah.
I mean, what would you say to someone that came up to you that's looking to actively look for a partner, whether it's in real estate or something else?
Well, the first thing I would say is, when you look for a partner, make sure that the partner has successfully done what you would want them to do. Because I've seen so many people enter into partnerships where they're like, oh, this person could be good. I want them to head up multifamily acquisitions. They haven't done that exactly, but they've done self-storage, or they've done mobile home parks, or they've done hotels. Nope, 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 nope. If they're a partner, they should have successfully done what you want them to do, uh, and also be able to teach you how to do that, if you are curious about it. But it should be a partner is the ultimate level in the business. So they should be able to take it and run with it and not have any direction whatsoever from you. That's a partner. A lot of people say, I want a partner, but then they find someone who they have to train, or they find someone that doesn't have that direct experience, and the results aren't there. So only bring on a partner if they have done what you want them to do, and they can take it and run with it. That's one thing. Otherwise, just hire someone, right? Most people get a partner, but it ends up being just a super expensive employee that they have to oversee. And that's a disaster. So that's one thing. Um, Another is test drive. Fortunately, in real estate, you can test drive on a deal by deal basis. And once you test drive on one deal or 2 deals, then you go into it together. So I would say, go out on your own initially. Don't have an official partner other than partner with him or her on a deal. Your company, his or her company, comes together, buys a property together, and then, and only then, after maybe that deal or a couple other deals, then all right, one jumps on the, just consolidate companies, or create a company together after you see how they operate under pressure, after you see how they operate on a daily basis, after you see how they operate with their communication style, written, verbal, all those things, ethics, everything.
Yeah, a lot of great information there, Joe. One thing I want to talk to you about that you kind of brought up a couple minutes back, and you're saying that Ashcroft value add operators, and what we've seen over the last couple of years as we've been through this window we're going through with multifamily is that many syndicators, especially capital raisers, but also some operators, have kind of like ventured into new asset classes. Some of them outside of real estate entirely that I get emails from, right? Why has Ashcroft stayed in their lane with multifamily value syndications? Because I think it's a great thing that you guys have done, because a lot of other operators are going all over the place.
If I want Italian food, I'm going to go to an Italian restaurant that hand makes their pasta. I'm not going to go to a diner that has lasagna next to chicken fried steak, because I know that the chef in the kitchen might be pretty good at lasagna and chicken fried steak, but they're not a specialist, and they're not especially focused on one thing. Because when we all know, if you focus on one thing and do it over and over, you perfect your craft. And that is why we only focus on multifamily.
That's another great answer. So as you're growing your business, before you met your partner, now you were starting with some small rentals. What did you, if anything, did you sacrifice to become successful? You said you were living in a 2-bedroom apartment without AC. what other things come to mind that maybe you sacrificed, you put on the back burner so you could really grow your real estate portfolio?
Nights out with friends, living in a more comfortable environment, one with AC. I'd say trips. Fortunately, I was single at the time, which I don't know, maybe an earlier marriage. I'm not sure. I'm married now, but maybe if I wasn't working so much there, but thankfully I didn't get married because I'm married to the love of my life now. So I'd say, yeah, I kept my fitness up, and still do. So I would say it was really just fun stuff that, I still had fun. It's just, I didn't go out as much as other people because I was also on the weekends. I would manny, I call it manny, male nanny. I'd go make, I think like 15, $20 an hour, which is a whole lot at the time, to work with special needs kids because they're the only ones. Those parents were the only ones who would hire a male babysitter off Craigslist. So I would go do that for weekends, and so I was pretty busy doing work stuff, teaching that class, working my 9 a.m. to 9 p.m. job, and doing that, babysitting essentially, and I sacrificed some stuff, but it worked out, and I would absolutely do that over again.
So as we kind of closing up here, before we get into more information on your company and how people can reach out to you, one thing kind of like to ask once in a while is people that think about legacy. And when you hear that word, what does that mean for you and you and your family and your business and everything like that?
I only focus on my living legacy. What happens when I'm dead is what happens. I can't control it. I focus on making an impact on people when I meet them now in this podcast. You can see behind me, I've got a death clock. No, my wife now calls it my 90th birthday clock. So it's my 90th birthday clock. It's ticking down to my 90th birthday by the day, minute, second, and hour. So I know that every moment's precious, and when I focus on legacy, it's simply being present in the moment where I'm at, and helping others while I'm living, and then what's said about me afterward, or even while I'm living, I put my best foot forward.
Well, thank you so much. How can listeners learn more about you, Ashcroft, anything else that you guys have going on, Joe?
You can go to ashcroftcapital.com, and you can actually check out the deal that we've got in Orlando, 5 minutes from Disney, and it's a value add Class A deal. It's something rare that I don't think you'll come across very often. And then you can set up a time to talk to one of our investor relations team members.
Well, Joe, thank you so much for coming on today. Put all those links in the show notes below, and have a great rest of your day. Looking forward to connecting with you here in the near future.
Absolutely. Wonderful interview. Enjoyed our conversation, Charles. Thanks, everyone.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.